Rental yield is one of those terms bandied about in landlord circles, but potential landlords are not always sure what it means because it's a number and most people don't really use it that often. And in very simple terms, the gross rental yield of a property is the annual income expressed as a percentage of the property's purchase price or value. Rental yield offers a useful overview of whether a property is likely to be profitable or not, so it's important. If a flat is very expensive and the market is so saturated with rental properties that the average rent is low, then the property might not be a good investment, and vice versa, and you want to make sure you obviously have good investments. Now I think that you should use the gross rental yield to compare different properties and look at the return to see how your money can work best for you. You can also use the figure to track the profitability of your portfolio over time, and the bigger the portfolio, the more important it becomes. After all, property values change and rents go up, but not necessarily on the same trajectory, so it's important we keep on top of our projections and numbers and actual results. Here's how you can work out the gross rental yield. First, work out what the actual value of the property is. Now you'll have this because obviously you bought the property, so you know what it cost you. Now that's going to be easy if you just bought the property, but if you own the property for a long while, then you might not remember all the numbers, so you'll have to look up the completion statement, which should give you everything you need, and that would have been given to you by your solicitor. Next, work out what your annual rental income is. If your tenant pays monthly, multiply the rent by 12, or if it's weekly, multiply it by 52, so on and so forth. Usually obviously most tenants pay per month. The calculation is as follows: it's annual rental income divided by the property's value. For example, if your property is worth, let's say, £150,000 and the tenant pays you, or a tenant pays you £450 a month times 12 gives you 5,400. It's 5,400 divided by 150,000 gives you 3.6% return. Now that's before your expenses, that's your gross rental yield. What we now need to look at is your net rental yield, and that's the net figure after you've paid out all of your expenses and things like letting agent fees, maintenance costs, accounting fees, insurance, mortgage, etc. You should obviously take out all the costs to make sure you've got the correct rental yield, net rental yield. And if there's voids, obviously that's going to be an even lower figure. Do not deduct any costs covered by the tenant, such as council tax and water rates. Using the example I just shared with you, let's assume you've got annual cost of £3,000. So the gross rent 5,400 minus 3,000 gives you 2,400. 2,400 into 150,000 gives you 1.6% return. That is not so good. I think it's very low, in fact. And your cost might be even higher depending on the amount of mortgage you've got. And if you unexpectedly have, let's say, a huge repair cost, or you replace a roof or something else, like for 5 grand, then you're into a minus figure, which means it's costing you to keep the property. Not good at all. So you don't want to invest into a vital property without calculating the rental yield, otherwise it might end up in tears and costing you money, in which case that's not the business we're in. We're in the business of making property work and having good property for tenants, but at the same time making sure you have a return, because you've got your money invested in there, you've got your time and effort invested in there, so it's got to be profitable and it's got to work for you. That's the whole thing about having a business. Whether it's property or not, it doesn't really matter. Now in general terms, the cheaper the property, obviously, the more likely that you'll have a good return if the rent is decent. And by cheap, I don't mean in a cheap area. What I mean is if you buy it below market value, or you get a good deal, or you buy it cheap and you need refurbishment work doing to it and you add value to it, and the value is higher than the money that you've spent. So it's important that you work out these numbers and you go into it with your eyes open. This isn't the only number you need to work out, by the way. There are 2 or 3 other numbers which I will share with you in a different video. And of course you can buy properties in a cheaper area, for example, but you can't obviously charge higher rents because the rent's dictated by the marketplace. You need to be aware of that. To maximize your returns, look for properties in popular areas where there's a high rental demand. It could be near universities, a commuter town or commuter route, and avoid properties with poor energy performance, and also avoid properties that aren't in demand, because you don't want to have long periods of void or an empty property. In existing properties, try to reduce your overheads to try and keep it as slick as you can. Obviously there's legal requirements and you've got to make sure the property is habitable and in good condition, but you want to make sure that you keep an eye on your costs. Now void periods are unavoidable, sometimes, and they're inevitable, but they can have a huge impact on your rental yields, because if your property is empty, then you're not getting income coming in, it's costing you. You want to try to minimize these, and the best way of doing this is look after your tenants, be nice to them, and make sure that they're comfortable. Any issues they have, go and fix them ASAP so that they stay with you for a longer period of time. Now number crunching, I understand, is not everybody's forte. It's not fun for most people. I like it and I'm an accountant, but there's some numbers you need to get comfortable with, and rental yield is one of those numbers. If property isn't performing as you hoped, or a prospective purchase is less than you expected, then you rather know that up front, as opposed to buying a property and then figuring out the whole deal doesn't stack up. Well, guess what? It's too late then. So just having 2 or 3 or 4 numbers you can just check, like on the back of a cigarette packet, is going to help you ensure that you're making a decision based on some metrics and some meaningful information, so you're not going into it blind or with your eyes closed. Numbers are very important in any business, and more so in property, because we've got big costs and big numbers involved in terms of the asset value that we're buying. So before you buy a property, there are certain numbers you should track. In this video, I'm going to share the first one I think you should be tracking, which is your gross and net rental yield. So if you're interested in how that works, watch the video.